you guys already have the lunch. Otherwise, you have to keep hungry the next 4 hours. So today I want to discuss one of my research study. I call as exception prioritization in continuous auditing framework and experimental evaluation. Before I go deep into this topic, into this research, I would like to know whether you guys know what is data mining, because some of this method I used in this study is data mining methodology. So let's first, so please use the clicker right now and switch to the channel 41. Do you know data mining? The first understanding it very well, or know a little bit, don't have any idea about it, or haven't heard it? Okay, let me see this. Okay, so some of you guys know it very well. Would you mind share your experience? We have 7%, at least 1%, right? Okay, the next question. So have you done any data analysis work? We can so for the data analysis we can use a different software. Basically, I don't think the Excel we can use to do the data mining. So we have some professional data mining software. Like the Weka, it's open source. You can download it online, and it's very user-friendly. They include all those packages to do the data mining. So let's start it. Before I go to here, so anyone can tell me what is data mining based on your understanding? You mentioned data. So the first thing we need to have the data, right? Then you can do some task, sort it, and based on your criterion to find the certain transaction or certain records, right? Any other? What is data mining? We know it's definitely related to the data. What else? Yeah. So you mentioned that if the data just a sample from the whole population. Yeah, so that's the things we use the statistics. Why we use the statistics? Because in most of cases, we cannot receive all the population. So we receive the sample. We use a statistic to say this sample can represent the population with certain probability. So you guys mentioned, so we have the data. We have to make sure the data have the good quality. Then what else? So you go to this step, so we can use some method to understand the data sets, right? Use some statistical method, regression, clustering. Yeah, you mentioned several keywords, prediction, right? So this is one of the function we want to use the data. So after we understand the data sets, we want to use the data set to make a prediction. Okay, so you brought to narrow it means so we want to find the data. Okay, attributes, right? Yeah, so it seems like we want to understand the data sets. There are certain probability, certain characteristics. Then we can use the characteristics to do something to make a prediction for the whole population. So let's see the thing I show here. So we can divide the steps of the data mining into the 3 steps. First, we have a data set. Then we try to explore the data set. We can use some basic statistic method, like a descriptive statistics or visualization method, to profile this data set. So this is a basic understanding of the data set. After we finish this step, we try to find the pattern in this data set. Basically, we try to find some characteristics under this data sets. So here we can use some advanced algorithm in machine learning, like the clustering, association analysis. decision tree to find the pattern in this data set. After that, after we understand this data set, we can try to, based on the characteristics we find in this data set, to make a prediction. Like, I want you guys give me some example how we use the data mining. Except Ping mentioned we can use the data mining to predict the sales. What sales? Yeah. Then do you have those type of research? And then take a look at their email, use text mining to find whether in the email they have the certain keywords to indicate this kind of happened. And also the email, the user, they send it to other people. Then know these people, they have the collection with each other. So then probably they have the insider trading. What else? Yeah, it's gonna happen. Yeah. So in a certain time, they have the traffic.
Targeted advertising.
Yeah. You see, the application of the data mining is to a lot of area. So here I list several of those disciplines that's linked to the data mining. The first is statistics. Why we use the statistics? So as I mentioned, basically we have the data sets. In most of the cases, we cannot access to the whole population. We just get a sample of the population. That's why, because to get the whole population is time-consuming, and the cost probably is very high, or it's impossible to get the whole population. So we use a sample, and we try to understand the sample to find the characteristics in this sample. Then we want to use this, want to see whether the sample can represent the whole population. So that's why we use the statistics. We say this sample can present the whole population with a certain probability, 95%, etc. Database technology. Why we use the database technology? Because it's data, right? We need to store the data in the database. Let me give you an example. So, except to store the data set in the database, what else? So suppose right now you wanna. Oh, I have several things here. Suppose right now you are the forensic auditor, right? And you wanna check whether some of the accounts payable, some of the records, or some of the transaction, the company then paying the vendor. Some of the vendors, they are not. So basically, you have if you want to find some of the vendor, they are suspicious vendor or virtual vendor. What you gonna do? So you have the tables. You want to find the accounts payable table. In your accounts payable table, you pay a certain fee to a certain vendor. So in your accounts payable table, you have the vendor name. Then you have the day you pay the transaction. Then the time you pay it, and the amount, right? If you want to check whether this transaction should pay to the certain vendor, how you do that? You want to link the two tables. Use the vendor name. You will link to the vendor master file to find this vendor here, right here, should be in the vendor master file. So that's one of the technology in the database. Not only store the data sets, we need also to find the link between two tables. Another one is is machine learning. So in the last 20 years, we have some new algorithm, like we mentioned, the clustering, decision tree, association analysis, etc. Pattern recognition, as we mentioned, is after we basically understand the data sets, we need to find the pattern in this data sets. And later on, we can use this pattern to make a prediction, to know the characteristic in the whole population. And then we can use some visualization technology to help us to understand this data sets. So I think the next month we have Abdullah will give us a lecture related to the visualization. So here is a several example of the application of the data mining. For example, this Monday I have talked to the person in the Morgan Stanley meeting. This person from the PwC, then doing consulting work. So I asked him, because he mentioned during the presentation, he will monitoring the data sets, not the data set, monitoring the tweets. Why they do this? I asked him because they want to know whether their clients certain products, whether some of the customer complain their certain products. So they download the tweets from Twitter, then they analyze the information in those tweets. If certain tweets they say this product they have a certain problem, so they use a text mining to do this. So basically, then we have the people first to program all those things. So then download this data sets and then analyze this data sets, whether some of those comments from their customers say this product have a certain problem, or this product is awesome, or this product is very good. So then classify those data sets into two categories, like the positive comments, negative comments. Then go to the negative comments and to find a certain keywords can indicate a certain problem related to this product. Then probably develop a report to their clients, say you can improve your product from this perspective. So all those things can be done automatically instead of people go to the website to check the tweets one by one. So all the things can be done using a text mining method. So this is the things I mentioned. We have the clustering. What's the clustering? So basically, we have all those transactions, like the 1 million transaction. We can use the clustering method to group some of the transactions. They have the same characteristics. Like those transactions, they have the same characteristic. We can group them together. We have a different method to group them together. So the next week we have the Paul. He will be here, give us a lecture related to the clustering. Association analysis. Is there anyone know the diaper and beer story? Diaper and beer. Is there anyone know that? It's really a very interesting story in the association analysis. Previously, there's a complaint, like for example, the Walmart. The Walmart, they have the whole transaction data. The customer go to the store to buy some products. They have the information, what's the customer buy, the certain items. So they use a data mining or the association analysis to analyze this data set. And then find a very interesting part. Then find those people then buy the beer, then buy the diaper as well. Otherwise, so then try to think why people do this. Is there any link between those two items, beer, diaper? Who can guess why people buy beer, also buy diaper? So then find probably some, the husband, the wife say, when you go to the shopping mall, please buy the diaper for your baby. So at the same time, they also buy beer for the football show, right? So that is the case. After they find this pattern, what they do, what's the complaint, the Walmart, for example, or Walmart do? Then put the two items together. For example, after the husband buy the beer, then we say, oh, diaper is here, I will buy the diaper. Otherwise, when go home, there's no diaper. So this is a very interesting story in the association analysis. So we also have the decision tree like this one. So we can, based on the characteristics, to classify those items. Okay, that's it. I think let's go back to here. After you guys have the brief understanding what's the data mining, what's the method we can use in data mining, or what's the application of the data mining, let's go back to my research. So when you say the title, you will say several keywords: exceptions, prioritization, continuous auditing. So this research is definitely related to the continuous auditing, right? And related to the exception. Who can tell me what's the exception? So let me show you the definition from the AICPA. They have the definition for the frauds. After see the definition for the frauds, you can see the difference between the fraud and exception. So exception can be a fraud or can be just a system error. So the exception are irregularity transaction or internal control violations. And the fraud is those will be certain victims suffering from those laws, etc. So it's different. My research study is related to exception prioritization. Generally, we try to prioritize those exceptions based on the suspiciousness of those exceptions being a fraud. Because before you know a certain transaction is a fraud, you don't know whether it's a fraud. You only know its exception. After the internal auditor or auditor investigates those transactions, then we'll know this is fraud. So this study tried to prioritize those exceptions based on their suspiciousness, whether the exception is a fraud, because some of the exception is a system error. So we prioritize the exceptions in the continuous auditing. What is continuous auditing? I think you guys already know this a little bit. No? Okay. So why not let's introduce our innovator of the continuous auditing, continuous monitoring, the godfather of continuous auditing. After understanding the concepts like exception and continuous auditing that's going on, so basically we have this issue. So first I will introduce the outline is what's the motivation I do this study and what's the solution I provided to solve this problem. Then we have the experiment. Then I will discuss the limitation of this study. So basically those firms, what's the motivation? Basically some of those firms, like in the 20 years ago, they don't have those computers, they don't have the continuous auditing system in their embedded in the ERP system. What they do, they hire those internal auditors to investigate those transactions, to find those fraudulent transactions. But in most of the cases, it's really time-consuming. It's labor-intensive work. So they want to use what? They want to use the continuous auditing system. You want to use the continuous auditing to solve this problem, to reduce the labor-intensive at the same time, to find those fraudulent transactions. In the 2004, and our Rutgers Lab have the project with the Siemens. Then developed a pilot for the continuous auditing system. That system, then it's good, and then later on they figure out that they have the one issue. What's the issue? Then find the number of the exceptions generated by the continuous auditing system is huge or large. So if the number of exceptions generated by the content auditing system is huge, if we deliver all those transactions, those exceptions, to the internal audit department for them to investigate, it's a problem because, for example, we have like a transaction is 1 million transaction, and we need to ask the internal audit department to investigate 1,000 transactions. It's still time-consuming, right? So that's why we want to prioritize those exceptions based on the suspiciousness. So this is the basic idea of this research study. So basically, the firm, they want to deal with the fraudulent issue, and they use the contents audit system. But there is one issue in the contents audit system right now. So the issue is the number of exceptions generated by the system is huge. And it's still labor-intensive to investigate those transactions. So we provide a method to deal with this issue. We want to prioritize those exceptions based on the suspiciousness. So it will reduce the labor. And especially those labor is really high expense, right? Those orders. You can see the expense of those orders in 1 year, $1 million. So that's why we need to depend on those technology to deal with this issue.
If you adopt the continuous audit and use it over time, the anomalies reduce.
Yeah, exactly. So when they keep use this, they can probably avoid some of the issue when the system get used to this data set or get used to the system. You're right. But still, the number of exceptions for the auditor, internal auditor, to investigate is large for them. Yeah, then do you have the certain methods to identify those transactions, whether certain transaction is an exception or fraudulent transaction error? And I will show you that method later on. You will see the things they do right now. So let's see. So in my study, so we provide a solution for this case, for this issue. So we provide a framework, try to maximize the labor source, the audit department labor source. What are we doing? So first, let's take a look at what they're doing. So you can see I have the screenshot here. So this is provided by one of the company. So they have, this is the dashboard they have in their internal auditor department. So their departments, for the accounts payable data sets, they have a different tests. And different tests, for example, then check the missing vendor ID, like the things I mentioned. Then check the missing vendor name, check the missing discount or payment terms, or check the missing vendor address, and check those stuff. And for each of those, we can call it a test. For each of the tests, we have the weight to show the capability of those tests to identify or to identify the fraudulent transaction. So you have the weight low, medium, high. So low, which means probably this test, if the one of the transaction triggered this test, this transaction has a low probability being fraudulent transaction. Or this transaction triggered this test, they have the medium probability to trigger to be the fraudulent transaction. So you can see they have the multiple tests, and then you will see here the number of exceptions or number of transactions trigger those certain of tests. You can say, for example, this one, they have based on the data they have 18 transactions trigger this test. So it has the percentage 1%. And you can see here we have then check the duplicate vendor name probably in the vendor the accounts payable data sets or in the vendor master file data sets. Then we'll say they have like the 46 records trigger this test. So the percentage is 3%. So they have this, we can call it a dashboard to represent these results. And after they have those results, what's they gonna do? Then we'll investigate them one by one. right? But if you add them together, this is 18, this is 46, 200, 300. Actually, here I just show you several of those tests. After you add them together, how much you have? Probably 1,000 or 2,000. How many people in the internal audit department? How long they needed to spend the time to investigate those transactions? So that is why we need a certain methodology to deal with this issue. What are we going to do? So we want to present those exceptions with a high suspiciousness. For example, one of the transactions probably then triggers this test. At the same time, then trigger this test. It's possible, right? One transaction triggers several tests. In this case, how we do that? We just combine them. So we use a certain method, we call it the function. So basically, the function is a statistical method. It was introduced by our dean, Glenn Schaefer. So he introduced this method, try to use, so we can use this method. So what the method is? So basically, the basic idea in the basic function is, if we have the transaction, we have, for example, if we say these financial statements have 70% represent 70% misstated based on the information we have. Can you say these financial statements have 30% probability is not misstated? Can you say that? Yes. Yes, based on probability, because probability we try to make a symmetry. We try to make the things. If there are two things, we just have two things, A, B. So if A do not happen, the B will happen. So if we say A happened at 30%, so the B will happen at 70%. So in this case, we say the financial statement is 70% probability misstated. So we want to say it's 30% not misstated. But what's the belief function used here? So if we have the, say, based on this information, based on those information provided by the external auditor, we know this financial statement is 17% misstated, but we cannot say it's 30% not misstated. We have to provide information to support this percentage. Because we only have the information for this 70%. We only know this information can support us probability, support us belief that this financial statement misstated 70%. We don't have any other information to support this belief. So this is the belief function, the basic idea of this belief function. So it's not based on probability. So we use a belief function because when you do, after you become the auditor, every test, everything you do, you want to have the evidence. One evidence can support your opinion, but it probably cannot support your opposite opinion. In this case, we use a belief function. We use a belief function to generate the suspicious score for each of the transactions. Let's say one transaction triggered two tests, like this test and the duplicate vendor name test. Trigger the two tests. We use a belief function to generate a suspicious score for this record, for this transaction. And we use a belief function to generate a suspicious score for all those transactions. Then after we have a suspicious score, we'll rank those suspicious scores based on the value. Then we only deliver a small amount of the transaction to the internal auditor for them to investigate. So let's see the framework. So here's the framework. You will see in some of them I use the data mining method. So that's why I would like to give you a very brief introduction of the data mining. So when you see it here, you will understand what's going on. Otherwise, you feel, oh, it's too technology. So, I'm sorry. So first things, we have the data sets. We have the trend. Here we can see it's a comparable data sets. And we have the expert knowledge. What's the expert knowledge? It's those tests provided by provider. It's those tests, right? We have those tests. Those tests are generated by their internal audit departments. They know the weight for each test. So we call it expert knowledge base. So we transfer those tests, program those tests, and they use some numerical value to represent the weight of certain tests. For example, we represent the low, we say it's 0.25, represent medium, 0.5, represent the high, 0.75, to represent the probability of the certain tests, the capability to identify the fraudulent transaction. Keep going on. So we have a knowledge base. So we, based on knowledge base to generate those rules, as I mentioned, we check the duplicate vendor name, duplicate vendor address. We have those rules. So we have the data sets and those rules. So those rules will say which transaction trigger certain rules, trigger me of this transaction probably trigger several rules. This transaction trigger one rule. Then after we have those information, so after we have those exceptions, we deliver this exception to these parts. We call it here. We call it usability function to generate suspicious score. Here I don't want to show you those mathematical formula. It's too much, right? So we use here to generate a suspicious score for each of the transaction usability function. Then we have the exception with suspicious scores. Then what we're doing? So we rank those exceptions based on their suspicious score. Then we only, like, I will show you this. Suppose right now, so if we rank those, here is the suspicious score, okay? Here is the transaction. So if we rank those transactions based on suspicious score, you will see the distribution will probably like this. You will see a lot of exception. Their suspicious score is like probably 0.5. Some of them they have a suspicious score 0.7. So we set a cat here. So we say only the exception with a suspicious score higher than 0.9 will deliver to the internal audit department for them to investigate. If they have more resources, they have the more internal auditors, they can keep investigate those exceptions with suspicious score lower than 0.9. External auditors then don't have the continuous audit system because their story step on the continuous audit system, and the continuous auditing system is for the internal audit. Probably, yeah, you're right. Probably this suspicious score is not very good. So that's why we have the keep going on. That's why we have the circle. We have the keep going on movements. Yeah, the threshold will based on the labor they have, how many people, how many internal auditors they have, and also will depend on the transaction amounts. For example, we have the two transactions, 1 year transaction. They have the same suspicious score, like the 0.95, but one the transaction amount is 1 million, another is 10,000. Which one you want to invest? Definitely 1 million, right? So we need to consider that as well. Consider the materiality. So which one is more important? We need to investigate this transaction first. Let's keep going. After we set the threshold, we deliver a sample to the internal audit department for them to investigate. So then we'll go to whatever they're doing. So after they finish the investigate, then we'll give us internal fraud reports. On this report, then we'll clarify which transaction is a fraud, which transaction not a fraud. We're going to use this information to update this system. How we update this system? For example, as we mentioned, so we'll use that information to update the system. What's the information we need to update? Here, right, some of these weights is low, medium, low, high. We need to update those weights first. This is one thing we can do based on the results, based on the internal fraud reports. We can update those weights. Yeah, exactly. Probably some of those tests not important, like missing vendor ID. It's never happened. We probably will remove some of those tests. What else? One thing. After the internal auditor find one of the transactions is a fraud, we try to identify the characteristics those fraudulent transactions. And those characteristics we can use to generate new tests. Those tests not exist here, right? We have these tests, so we can add new tests to this system. So this system can become much stronger, I'm sorry. So this is the basic idea. So we add a new rule. You can see we add a new rule to the system, and we refine those rules. We change the weight, change the numerical number that represents the capability of those rules to identify those fraudulent transactions. So this is the things we do. We update the rules confidence.
First is the idea of a population. What is a population? Basic statistics. What is a population of transactions? Is the entire set of transactions that you're talking about, correct? So this is a population. Now, with big data, we are start getting to the situation that your databases are not containing your entire population. You have things outside the population that you are monitoring. But at this moment, we are only talking about the population that you are examining. Could be accounts receivable, accounts payable, cash payments, anything that you can imagine in accounting. Now, traditional accounting, traditional auditing, you pick up a piece of this population, we call that a sample, and you extrapolate to the population. What does that mean? This is 1/10 of the population. You examine these numbers, put a total on them, and then multiply by 10, just a simplistic way, to figure out what is the value of this population. So if this is receivables, you come up with 100,000 as your extrapolation. The management is telling you that the value of this thing is 105,000. It's a little bit different than what you estimated, but not terribly different. So you say, okay, the balance sheet is correct on that particular item. So this is the idea of sampling and expanding to a population. Now, Pei was talking about this idea of faults or aberrations or whatever you want to call it. Is within this population, there is a certain number of transactions that are not normal. And lot of research on this area. A guy called Steve Albert from Brigham Young University has done most of the research in the early days on this. And basically came out with the following rule of thumb. Out of 100 aberrations you find, 5% are fraudulent. So when you find things in a population that are not right, it's not always fraud. And many researchers and many laymen think that everything you find different is wrong, it's fraudulent. Not at all. Large majority of things that you find that are aberrations are data errors, are system flaws, are key entry errors. Yes, David. Why don't you hold this question for about 3 weeks from now? Because we are going to talk about Benford law. Benford law is one of the data mining analytic methods that you can use. I am not a big fan of Benford law, but Mark Negrini, which is probably the person you're talking about, is the big advocate of it. And every one of the big four uses Benford law in one thing or the other. Okay, but we'll come back, don't worry. Now, next part of the discussion. So, within a population you have aberrants. Within those aberrants you have some kind of fraudulent transactions. Most likely, if your population is large, there always will be aberrants, there always will be fraudulent transactions. Pei uses a thing from the Fraud Institute, Fraud whatever, Analyst Institute, that talks about 7% level of fraud in all transactions. Everyone uses that. Rod Brennan uses that. Everyone uses that. I find it highly, highly dubious that those numbers are realistic. They are just exaggerating the facts. Of course, there are places that you can find a lot of fraudulent transactions. But if 5% to 7% are fraudulent, and Albrecht is right, 70% of the transactions are aberrant. So that makes no sense. Okay. And you start thinking about numbers, 7% is large. Next thing, you have set of transactions that are flowing through your business. Some of them are going to be aberrant, some of them are going to be correct. Agree with that? Now, you are going to put a filter in front of it that is going to try to detect fraudulent transactions. Now, same number of transactions will exist after the filter, except some of them are going to be considered fraudulent and some of them are going to be normal. And actually the word that they use is positives and negatives. Okay? Now, what happens if you create a filter that is very tight, a filter that will choose very carefully what is false as opposed to a loose filter? What's going to happen is that your positives are going to go down and your negatives are going to go up. It's just the strength of the filter. If you make a looser filter, you go the other way. So I bet you that in the last 5 projects that we started, 2 of them, they said things like, we want to reduce the number of false positives. What does that mean? That means a transaction was chosen as being positive. Some of them are real positives, the other ones are false positives. Okay, and what is a false positive? Is a transaction that you extracted for analysis, and then turns out it was okay. Now, we have the opposite too. Forgot about those. We have negatives that are really negatives and false negatives. What is a false negative? It's a positive. Okay? Now, you start fooling around with your filter, but if you make the filter tighter, you get more false negatives. If you make your filter looser, you get more false positives. Okay? There is no other state of the world. There are 4 states of the world: positive, false positive, negative, and false negative. That's it. Now, in reality, there are more states of the world. Why do we say that? Because some things we'll never know if it was positive or negative, because there is a new type of fraud there that you don't, even if you look at it, you don't recognize it. But the world thinks in positives, false positives, negatives, and false negatives. And every time you go and talk with reasonably educated auditors, they always talk about reducing false positives. And they don't understand the implication of that. Now, of course, what you can do is improve the quality of your filters in a way that you are better at detecting positives. But still, tighten your filter. What you are doing is creating more false negatives. That's the first thing. It's understanding what a false positive and false negative is. I wasn't guessing. I was citing Steve Albrecht from Brigham Young University that did a study in the old decades of distribution anomalies in relation to fraud. Now, when he did this 30 or 40 years ago, the systems were not as computerized as they are today. So maybe his ratios were different at that time. I haven't seen any recent study that looks at anomalies and tries to classify them. Yeah. We got a file, very large file, 745 gigabytes of information from Procter & Gamble. And they had given this file, was a payments file, and they had given this file to Ernst & Young to examine. And then they had this idea, let's give it to these professors to examine it. So I had Siripan, who was a Thai PhD student, examine that thing. She found 149 duplicate vendors. They are not, that doesn't mean that they are fraudulent vendors. But if you have a duplicate vendor, you could make the same payment to the 2 vendors and doesn't look duplicate. They finish up being the same vendor. And how do you do that? One company is called Ping Co. The other one is called Ping Co. Control H, that you can't see. So in the screen, they look exactly the way. It could easily be a data entry that got tired of getting, don't enter this as duplicate. He's just added a new vendor there, sneaked it in to make his life easier. But easily could be collusion. Yes. Exactly. This is the kind of thing. And so just because you find duplicate is not fraudulent. To be duplicate and to be fraudulent has to be it goes on the ledger of the receiver and disappears, so you don't get the credit. So you have 2 payments earned. She receives the 2 payments. Inya says, one for the company, one for me, and pulls it out. Okay? And that usually means collusion. Means I give someone a little bit of what I managed to make. It's collusional payment. So when we found all these duplicate vendors and thousands of duplicate transactions, they went after them, obviously, and they found many of them, they got credit 2 times, but some of them they didn't. And their amounts of money were large. And actually there are these guys called bottom scrapers, and they come in for free and look for duplicates, payments. And they collect 50% of what they can recover. And they make a lot of money out of that. We worked with a company across the street here that you'll see the name across. And they said, we don't need to look at duplicates. We have Oracle, whatever they had. We don't, and we have these bottom scrapers looking at it. We went in there and we found a lot of duplicates. What we found there is they had like European pay system, American pay system, and I think it was Asian, but I don't remember where the third one. And they're actually paying the same bills. Okay, and There were several vendors that were not giving double credits. Okay. In addition to that, for duplicate pay, duplicate vendors and all kind of things. So this idea is not possible because the systems are there. It's not a very strong idea. If you are NASA and you run 3 separately programmed systems by 3 different people and run on the same data, then you might be a little bit more accurate. But these systems are not that exact. Yeah.
You're having bodies, right? Some people give away 50% of what they have. So you realize that every time they come, you have so many duplicate invoices or duplicate transactions that you do things for that. Wouldn't you stop bringing them in and hire someone for a fixed rate?
Yeah, that's what they do. First 50% is high, is usually less than that. I said 50 because that's when they start, and then they negotiate it down. The second thing, you always wonder if someone in your company is not getting money from those guys to be hired. Okay, so it's very first, secondary, tertiary type of fraudulent behavior. But you see, I always say with particularly my students and young faculty, I say fraud is not the motivation for these things. The motivation to these studies is to decrease the systematic errors on your systems. If you can decrease the systematic errors on your systems, you are much better off. Then you worry about fraud. And fraud is a kind of a different animal. And people think always this thing that this is fraudulent and this is not fraudulent. There are a lot of things in the middle. A lot of things in the middle. You use a vendor, the vendor charges a little bit more than the other vendor, but not much more. And just happen that every time there is a Yankees game, he gives you tickets to the game. Is that fraud? I think a lot of people say yes. But a lot of people say, no, it's a little favor, it's my buddy, we went to high school together, he's the brother of my wife, I should be giving him business, etc. It's very, it's very easy to take the black and white view. When you take the black and white view, you don't understand the gray. And that's really bad. We are going to have Denise come here, or Abdullah, talk about the Procter & Gamble expert system we developed for them. And this is an expert system that looks at what they call pay card. And this is, many people in Procter & Gamble get the company credit card to pay for purchases of Procter & Gamble. Okay, and there we developed, and then they have a woman there called Lisa, and I mentioned this before. Woman Lisa that evaluates these purchases and see if they are within company rules, not to use the word fraudulent, abuse of credit card. Basically, there's a whole set of rules that say if you're buying beer, and this is a weekend, it's very unlikely that this is a legitimate company purchase. But it could be a party of the company that you're buying beer for. Okay, and so actually this kind of knowledge-based, rule-based systems are used extensively by credit card companies. Actually, there's a company called Falcon that they have very complex knowledge-based systems to identify fraud. And companies like Citibank, Chase buy these services. Even Itaú buys Falcon. Okay, and what that thing works on the rules like, I'm always transacting New York City. Today is a transaction in Istanbul. Okay, could easily be that Michael is actually vacation and seeing belly dancing in Istanbul. Okay, could easily be, but Michael didn't travel to Istanbul, so I don't see a receipt here of an airplane flight. And Michael just did the transaction in New York City. Okay? And so these are the things that they detect. Okay? With a person like me who travels a lot, they actually relax the rules a lot. So in the beginning, I used to get a lot of these calls. Now I get much less. They put in their files, this guy travels a lot, etc. The other thing is this guy has several cards, so don't expect correlation of the cards. Meaning, Namita travels to Istanbul. Okay, she has one credit card. So she pays the airfare, she pays the taxi, she pays, etc. And that's it. And these are logical inferential rules that they can develop out of this. But, you know, credit cards are really looking for fraud. What I'm talking is bigger scheme. Yeah, they look at the timing. The other thing they look is they know your profile of things you buy. And, you know, you have a child, you buy a lot of baby stuff, but you don't buy eclectic gear. And so it goes out of your profile, they look at. So they have these different parameters of behavior. It's behavior-based, rule-based. There is no big theory behind this. It's all about behavior. But this thing, there are bigger theories of that. Yeah, interesting question. Let me ask you a question back. Well, let me ask you a question back. And I have an example for this. Parameters are confidential. Your company reviews your credit card payments and then calls your attention to something. It's very good because they're finding some fraud. But it's very bad, or not very bad, but it's not that good, because they are not changing your behavior. Okay? At Itaú, we used to have these daily monitoring of the 14, it wasn't Itaú, it was Unibanco, the predecessor bank. They had 1,400 branches. 1,400 branches. They every night examined transactions. And there was something that was happening, was DAF reversion. DAF is tax payment in the cashier. In Brazil, you have to pay your annual taxes. You send your tax return to the government, but you don't send a check, or the check will disappear on the mail. So what do? You go to Itaú, give them a copy of your tax return, the amount is there, they have electronic, they collect your money and give you a receipt. What the cashiers were doing is they were reverting that transaction, because you could make a mistake and revert. Picking up the money, putting in the pocket, and not saying anything. 2 years later, the Brazilian IRS would discover that Inha didn't pay her taxes. So send Inha a letter, say, where are my taxes? And she would say, here is my receipt. So I pay my taxes. And then who would pay for it was Unibanco. So we got about 400 of those events in 1 year. And Itaú lost a lot of money because the penalties were very heavy and the interest rate was around 40% a year, Brazil, correct? They lost millions and millions of reais. So we put a filter in for that. But people discovered, the word went out, there was a filter. You know how many transactions like reversals DAF happened the next year? One. And this one was a justified reversal. We went and audited. The moment it happened, we jumped there to look at it, and we caught it. And what is this? Because behavior was changed. So this is answering your question, Yaron, about this. You want to use fraud detection rules as also a way to keep people honest. You know, you lost half of the battle when you have to catch someone and fire. Okay, the best is that he doesn't do it. And so when we do all this filtering that we do, we always have what we call public relation campaign. We basically let know the employees that we're watching. And
But it wouldn't specify the filter. Let's say that
no, we don't give them the specific parameters. We say we are monitoring overdrafts on accounts. So what happened? The branch managers that allowed the overdraft and maybe got a payoff are wary of doing that. Okay, so, and that's a real example. We, at Unibanco, before we were in Itaú, we had a guy, Newton. He was the head of continuous auditing, that's what they call. But actually it was the monitoring part of it, the people that look at the exceptions that came in. And he had the power to change parameters. He actually, after the DAF things were not happening, he basically eliminated the filter, was taking too much computer time. Okay, so you give that authority. And of course you always worry, is this guy on the take too? And he's helping someone. So, you know, you can't trust anyone, correct? Not true. Now, I'll continue this. So Hussein, I don't think he'll come talk to you, but maybe he will. Dissertation was, He called it exceptional exceptions. And the problem he was dealing with is what Pei gave it a different name, but she's dealing with a similar problem with a different method, is when you pull your positives, your sample of things that might be aberrations, with a very big database, you're coming up with too many transactions. You don't want to tighten the filter too much because you're going to have a lot of false negatives. So you finish up with a large number of transactions, not as large as the population, and you have limited manpower. That's what Pei said here. So what do you need? You need to create a hierarchy of the things that are more likely to be fraudulent or to be wrong. And Itaú, they always tell us, nothing below 5,000 reais you even talk to us. 5,000 reais is $2,500. They're not interested in small transactions. I don't like that, so I put them aside and do my other analysis on that because I'm worried about a thing called salami technique. You know about salami technique? Salami technique is a rounding fraud. You, instead of rounding things up and down, when you get to the tenths of the cents, you just round it down. So for every transaction you have, you are basically pulling out half a cent. So if you have 1 million transactions, half a cent of a million transactions, you have some real money. And so this was a classic fraud in beginning computer systems. You would do this rounding down, and then you would calculate what would be your saving and pull the money out for yourself. And actually the first one of this was caught because the guy, instead of making a statistical estimate of how much money he would have, could pull and keep the books in balance, he actually made an entry in his own account of 1/3 of a cent every time he did it. So when we did this run through this, which was Touche Ross at that time, Deloitte and Touche now, or actually now only Deloitte, we ran a whole set of tests on this thing, and we found this very strange aberration of one account with millions and millions of entries. And they were tiny entries. Took about 20 seconds for me to figure out what that was, once I saw that piece of evidence. And actually, that's another thing related to Pei. Pei had a whole list of things that could go wrong. We could write a little script to pick up each one of them. Certain aberrations are very clear what's happening. It's a doctor, you go visit a doctor, you have a whole set of symptoms. Certain symptoms are totally revealing of one particular disease. Other type of symptoms is a whole set of things that could happen. And they go to a decision tree in their minds. Of this evidence, that evidence, and that evidence. So the first of these dissertations, it was not called exceptional exceptions, was Youngbam Kim, Korean student of ours, now a professor at Ramapo. And what he did, he picked up types of evidence that Pei was showing and created a Venn diagram. We found that this guy here, all of these had manual entries. A manual entry is much likely to be fraudulent than a non-manual entry. Then on this one, he found that these were dupes. And this one, he found that these were wrong account numbers. And I'm making this up. I don't remember what were the. I just remember the manual transactions, what he did. So there were 300 here, 700 here, 90 here. Here there were convergent of these two. There were 15, 19, 25. And here there were 7 that happened fall in these 3 criteria. So it's very clear that the most likely bad transaction is the one that fails all those 3 tests. And then the other ones fall into these categories here, and the most likely other ones are in these categories, and these are most likely not a problem. They didn't fall that fell only in one criterion. And of course, this is part of a generic population, and the ones that were not picked on these three are even cleaner. So you can create this hierarchy. And what she did, this was just so every time you fell in the criteria, you got a 1 point, and if you have 3 points, you're a real bad guy. 2 points, so-so, 1 point, less so, and 0 points is good. But this wasn't good for Hussein, and Hussein basically the behavioral judgment. He kind of ran a little experiment and came out with an equation, and I think Pei calls it a suspicion score, and I call it equation loadings. And you basically come up with an equation. You create an equation, x equals x1 plus x2 plus x3. And what Young Bumkin did is get a weight of 1 to each one of them. And what Hussein did is he gave another weight here based on behavior factors. So every transaction goes through, you look for these parameters and give it a number. And if this number turns out to be close to 1, if you're going between 0 and 1, this is a high suspicion score. And if this number is low, seems to be a pretty clear transaction. And when you do auditing in a traditional way, you actually use the kind of things I'm describing, parameters of the transaction and values of the transactions. And what Pei is doing is using belief function as a way to estimate the suspicion score. And what Young Bum did, he used just kind of 1 parameters. And what Hussein did, he already did some behavior estimation that he thought related to this. Now, what we more recently started talking about doing, this is all traditional accounting, meaning this is numbers and rules of control. Now we are thinking of adding 2 more parameters to this, or maybe do this without these other parameters. And one is the thing that we call clustering. And the other thing is what we are calling process mining. And I'm going to give you a very fast explanation of this, and later on we are going to talk a little bit more about this. But this is, don't even write this on the CPA exam because they are not going to understand. And by the way, they most likely won't understand this either. Okay? This is modern auditing, and we are getting there. We're actually bringing the PCOB in here to explain these things to them the way what we are doing here. Now, these are very, very interesting. She mentioned clustering when she was en passant in data mining. And I'm going to have some slides that I can show you later, but I want to just go into this without the slides to make you understand a little bit. Clustering is multidimensional. Clustering is a technique of statistics that picks up a large sample, uses the different variables of it, and puts them in groups that are similar. So you finish up with a graph, and some transactions are here, some transactions are here, some transactions are here. And with a public domain software called Weka, you get them in nice colors. So one of the parameters, you look at 2 things when you're doing multidimensional clustering. One thing you're looking is what the groups mean. We worked with an insurance company, and we found one group with transactions that were payments of life insurance 6 to 9 years after the person died. And when I asked them what this was, they said, oh, no problem, this is litigation. Daughter and son are fighting who gets the money. But I kind of looked at it and I said, it doesn't take 6 years to resolve this type of litigation. So that sounded a little bit funny to me. So I pushed a little bit more on this, and they wouldn't give me the answer. So we went and looked at the deposits, and turns out that several of the deposits were made to the same checking account. So it was pretty clear collision, although I not that confirmed. Why didn't I have that confirmed? Because then I talked to the head of the audit there, and he sent it to legal. And legal never tells you back what they found. Human resources and legal. And therefore we stopped working with the insurance company, because if they don't tell us the answers to what we found, we can't work with them, correct? It's like a detective that even he finds that the murderer can't be confirmed that he was the murderer, correct? It's not right. We can't do that. Now, the other thing that you look, and this is a cluster, and there are transactions out of the cluster. And so what we look is the distance from what we call the geometric center of the cluster. And basically this says this is an asymptomatic transaction of this group. And what we think is we are going to use these distances as one parameter here. So mixing traditional auditing with clustering geometric distances. One more that is very unusual and very interesting. We hope to have a paper published very soon on this on the Best Accounting Journal. And this is called process tracing. You have, remember I designed the ERP as being a big database and a lot of applications. Correct? Yes, no, maybe? Within a process, you have different, you post to the ledger, you examine the ledger, you get approved, whatever the things are. Okay? And what happens to a transaction? It goes like this, it goes like this, it goes like this, then goes like this. But some of them don't need approval, so they go something like this. Go from here to here, then directly to here, and then out. This is just like if you are getting a bill paid in the manual system. The manual system pass it to Danny does his thing, pass it to Ping, pass it to Wiesel. Just like this. So when we started thinking about this, we found this literature in industrial engineering that talks about process mining. And we said, this is perfect for auditing. We look at what done. This is what we did in the old days. In the old days, you had audit trails. People signed things, and when you are examining a document, you saw who signed it. So was this everything that you needed 2 signatures after $10,000? Did it get 2 signatures? Okay? It's obvious, correct? Well, when you have an ERP, you have a thing called a log. A log tells you what happened with that transaction. So we extracted the log, and we looked at what happened in this payables process. And what we predicted that was going to happen is like what happens in any very large statistical processes. You have a population, and a certain category takes over this, and about 5, 6 categories explain 80% of the events. So we're expecting that about 5 paths, 4 paths would take over 90% of these events. It was totally true. 5 paths took over, let's say 90%. I have the tables, I can show it to you. But what we found also, so this is 5. We found another 300 plus paths that were through this. And there were so many paths, and we really didn't have access to the bank. This was a large Dutch bank, that we couldn't explain it. And so we're actually intending to use paths as a weighting scheme on our suspicion equation, or on the loading factors. This is all modern. This is not new thing, and it's not old thing. But I'm going to show you some slides on process mining, and you are going to find, first, they're beautiful. Second, they're awing. It's like the same methodology. Come to you 1 second. The same methodology that you use in analyzing social networks. Ping called Joe. Joe called Yaron. Yaron calls Ping. This is what you do, analysis. When we did this in telephone, AT&T, to increase the sales of AT&T, we started to understand the peer groups, and actually MCI came out with a marketing plan called Friends and Family, and was closest people that you define as friends, 5, you didn't pay for their phone calls. seller faults. Okay? It was a killer of a plan, a real good plan. We had proposed something similar. AT&T said, we don't want to do that. And once they came out with the plan, AT&T had to rapidly respond with a plan. And this was all based on network analysis. Guess who uses this? NSA, of course. You are Jeremy Abu Abba. And then you call Namita Abu Ibi. Okay? And you know what Abu means? Son of. Father of. Oh, you knew it, huh? And we, of course, didn't know this. But we are doing this analysis for another project we have. And there are thousands of Abus. And this software couldn't differentiate, talk about false positives. Okay, we got thousands and thousands, like 150 pages of Abus. Okay, and they came to us with this thing, said, we have to do something about this. We can't do it. And then Abdullah, who you are going to meet, was in the group. He said, oh, Miklos, we know what this is. So now my name is Miklos Abu Miklos. Because my son is called Miklos. Okay, and he said, you can't do it this way. And then the other thing is that all these Abus where one lived in Saudi Arabia, the other lived in the Bronx, and the other lived in a suburb of Paris. So, the likelihood that they are all part of a grand Abu schema is very, very low. Okay? And this is false positives mindlessly mined. Okay? But this idea of looking at networks of behavior is very powerful. Now, at the same time, it's awfully ugly, correct? Meaning it invades your privacy. There's really, Ping wants her sister to know that she calls Rizal every day and they talk and they're good buddies. Her sister can't stand Rizal, okay? I just kind of come out the exam, but it's very intrusive. If looking at your telephone behavior or your email behavior in networks, it's very intrusive. But there's nothing you can do about this. Everyone is doing this. You know who is doing this a lot besides NSA? Marketeers. People that buy certain things talk to people that will buy those certain things. So you need to find out who is the people they talk to. And then you're going to see this predictive inferential learning that now things like apps here use, predicting what you need to do. And that's all network analysis. So we kind of mixed these things together as a form of gathering evidence for audit. So kind of just going back to finish up the pay story here. You have a big population. Out of the big population, you have a subset of the population that's anomalous. Of that anomalous population, you have small population that is fraudulent. When you are doing your filtering, you are looking for things that are anomalous. You don't know they are fraudulent at that particular moment. And then you pick up positives and negatives. Those positives could be really a positive or could be a false positive. Those negatives could be a real negative or a false negative. If you make your filters very tight, you are losing some positives, calling them negatives. If you make them very loose, you create a lot of false positives. Now, one thing I didn't say that should be obvious for you, how do you decide how do you parameterize that filtering? What is the method of decision? That's one way to parameterize, but you also need to think about one thing. How costly is to examine your faults? Okay, and sometimes just the direct cost doesn't really matter. The direct cost might be big at one time, but you are doing systemic fixes, and systemic fixes decrease the number of errors in the long range. So every time you find a real fault, you need to look back and say why this happened. What control didn't exist? What control was not obeyed? What's wrong with your systems? There is one more thing that is causing a lot of problems, is the fact that in old days, everything was in your company. Correct? Everything in one place. You went and bought SAP, implemented SAP as one thing. It was reasonably well controlled. Today, half of your data is outsourced and insourced and related to other things and borrowed from another company or is fed to you by your suppliers. So you don't even have control on what you have. And so that makes things even worse. Okay? But the problem that Pei is dealing, a problem of identifying anomalies, it's a problem you're going to live your life with. And I should have said this at the beginning, and not everyone will agree with what I say, but I think this is very legitimate, is not possible to audit in this environment, in the ERP large data environment, manually. You have to have automatic audit tools performing all the time, and then you as an auditor will deal with the exceptions and deal with the controls and deal with the system anomalies. And the better your system is, you are going to do a higher and higher level of intellectualism around this thing. And we are going to talk and talk and talk about this for the next 10 weeks. And I don't think you would get this in other courses, in other schools, because we do this research and other people don't. And so this is kind of a little bit different. You're not going to find this in the CPA exam. I kind of laughing because I remember we, maybe 10 years ago, 12 years ago, we were very involved with the XBRL effort. Oh, more than 10 years ago. And we are designing XBRL at that time. I was in the committee of the ICPA. Before that, we were talking about XML applied to accounting, this whole thing. And so the students here learned about XML, and you're going to XBRL, and you're going to do the same thing. And then they went and talked with the recruiters about XBRL. And the recruiters had no idea what XBRL was. Okay, and some took it pretty good, say, yeah, she's smart, and et cetera, et cetera. Other ones said, this guy's a nut. And it came to the point that I had to give a call to an unnamed firm whose name starts with a P, and ask this partner to call the recruiter and explain that it was his ignorance, not my student's ignorance, because it had come back to me that the recruiter was commenting about nuts. And so it was kind of interesting. So be careful when you do your recruiting here about what you say, okay? Okay. But you know, sounding a little bit analytic, sounding a little bit statistical is good, I guess. Okay?